Hello everyone, and welcome to the weekly Q&A for May 24th of 2023. We had a couple questions basically around debt ceiling. So, let's kind of dig into debt ceiling a little bit more. It's kind of an interesting topic as far as like what does it mean macroeconomically, what would happen, right? So we can cover probably a few things here today. Today's probably going to be a quick one, but of course, always if you wanted to throw a comment or a question in YouTube Live, I will definitely be able to get to those, and I will put my focus on those first. But first and foremost, let's kind of dig into just where the markets are, what's kind of going on in general, the life of things. There's been some excitement in the markets as far as just a couple down days that we've had. If I turn this to a one-day time frame, you can basically see that we've had just a couple days. All it did was reverse back into this little volume range that we've had for a little while. By the way, there's a lot of stuff on this chart. Normally I leave a little bit of a cleaner chart, but there's some technicals on here that we use in the Adapt Advanced system. So I figured I'd throw it up here just so that way I can talk about the general volume areas that we've been looking at and things that we've kind of been paying attention to. So we did have a Wyckoff channel that was pushing sideways into it, and then eventually it broke. We kind of redrew this, and then of course we've broken again. So in general, these target lines that we had up here has basically been a pretty solid resistance to them. In general, though, we do still have a lot of bullish pressure on here, bullish macroeconomically, bullish in many ways, right? So even though we've got these down moves, in general, nothing's exactly signaling like it's going to be the end of the world or anything like that. So there's a lot of fear out there about the debt ceiling, what it's going to do, what it's going to be like. And, as far as just before I go diving into what would happen if, the debt ceiling doesn't, get resolved, things like this. By the way, we go through this every year now. So this is basically just, par for the course. But anyways, in general, we definitely do have a lot more options pricing that we're basically going to trend higher. Of course, as you guys know, if you're part of the Adapt Advanced, you guys know my macroeconomics have basically started to push a little bit more into the neutral side. We're basically in clear for the recession. We've been clear basically since about right here was, I think, when my macros started to shift pretty aggressively. That was that Fed announcement back on March. So since then, we've basically been trending higher, a little bit of stall up here and some resistance and stuff like that. But we do anticipate us to push higher up into this 4,300 level or so, something like that, at least until the next inflation kick starts to kind of happen. As far as the Fed is concerned, we basically are projecting the Fed to continue hiking interest rates by one more. But that is kind of, it's hit or miss, right? We can actually go to a really nice website here. It's called the Countdown to FOMC, and we can actually see what the market's pricing in. We'll go ahead and grab that. So I'll share that over here. So the market is pricing in about a 36% chance of them cruising up to about 25 basis points on this next one. I'd probably put it more at 50-50, but that's okay. That's what the market's pricing in right now. The inflation has cooled off quite a bit. Job growth is, it's stable, and it's basically everything's hunky dory, right? So. That's as far as macroeconomics is concerned. That's that. There's a lot of talk about a recession, guys. We were talking about a recession in late 2021 was when we were talking about a recession. We knew we were in a recession last year as we were talking about being in a recession. The key was the slowing growth at the end of the recession going to be meaningful for assets, and it was for the Russell and stuff like that as our bearish. Indication as our bearish macros were still putting a lot of pressure. So the Russell showed that slowing growth a lot more than the S&P. I can show you that over here. If we go to something like the Russell, well, let's pull up the rut. There it is. So if we go back to the Russell, basically our macroeconomics said that we basically started to turn the corner right here in March, right? So boom, like pretty much right at the bottom here, and that's basically been bullish since. We'll see what happens as far as small caps go. They are pretty financial heavy, and banks are, they've got some challenges ahead of them. But this should actually trend higher from this point on. We put in a really nice base. That's pretty much done for the recession. That's a really deep recession as far as recessions go. It was about a 30% pullback. So solid, nice, normal, everyday recession. It's an inflationary recession, so it works differently. And from there, where are we at? So as far as this debt ceiling, I wanted to knock out this question because I've gotten a lot of questions about the debt ceiling. And a lot of the time, a lot of the traders that are in our service are like, it's not too big of an issue, and they're just kind of more curious about it because most of our systems take care of all this anyways. So the thought is let's kind of walk through the chain of events that happen when you get something like an immediate halt in government spending, right? So there's three ways money can come into the system. And what I mean by the system is, like, let's just say money coming into the economy. And all three ways of money coming into the economy is, inflationary, right? So the primary one that everyone kind of thinks about, because we're, a lot of us have been taught to work for our money, right? So the first way is that the country that we're talking about, right? The country does work for other countries, right? And as that work for other countries pays out, the trade surplus would come in, or I shouldn't say a surplus, but there would be a flow of capital through trade into the economy. And there you go, right? So there's money coming into the economy in that sense, or basically investments into the country in which we're talking about as well. So just outside foreign capital coming into the country. That's what we're talking about. Any kind of foreign currencies coming into the country is inflationary because it's investments in that country. And so it's money coming in. It'll be converted into their dollars. It'll push up their assets, and voila, there you go. So that's kind of the primary way of the regular school of thought as far as how money gets into the system. Well, then there's another way that money comes into the system, and that's through monetary policy. The way that we govern our currencies now is that if we drop interest rates or we buy financial assets, it basically prints new money and injects it directly into the financial system. And that can be inflationary too. It's more inflationary for assets than it is the actual underlying like CPI, for instance. So we're going to be really focusing on assets right now, more so than CPI inflation, because they are not the same, right? So our next step for this is the third way that that money comes into the system, right? And that's when a government borrows money from foreign places, right? That can be its own central bank, as we've seen with monetization of debt. It can be from another country that's outside of it. If it can borrow money and then spend it into its own economy, that's inflationary, right? So now that we kind of know the three ways that money comes in, there's a constant flow of money coming into a country that is that is having inflation, right? And we have inflation, right? We have positive inflation, right? So what happens at this point is that if the debt ceiling was not raised at all, right? What would end up happening is we would get a stop immediately of all government spending that comes into the economy. And there's a decent amount of government spending that's coming into the US economy right now, and actually most economies around the world. So if the debt ceiling doesn't get raised, that would just immediately halt. Well, what would that do? Well, it would cause a massive deflationary event, right? Because there's this constant flow of inflation, and all of a sudden it would just be stopped. And so that trajectory, that momentum of that inflation would all of a sudden just halt. and your rate of change on inflation would just stop. And so it would be really deflationary, and more particularly deflationary to assets and in the economy, because there's that spending that's not coming in there. So what would end up transpiring is basically it would probably be a massive sell-off in markets. It would be a liquidation of pretty much everything, because you'd want to be rushing into the dollar, because the dollar would be getting stronger, because now all of a sudden none of them are being, not as many are being printed or being put into the system. And then basically what that would do is it would weaken other currencies versus the dollar, and then the dollar would just go straight through the moon. And inevitably that would be inevitably long term, it actually might have been a good thing long term, but short term it would be very violent. It would be extremely catastrophic, in fact. And then of course that would have spillover effects into any company that's leveraged and all that stuff, because their assets are falling, and it would just create this big deflationary spiral, right? It would basically kind of be like, if you could think of kind of like the crash that happened in 2008 in like October, that deflationary spiral like that, that's probably what would happen. The Fed would likely do something in the middle of all of that. It would not be a pleasant experience, but what the Fed would end up probably doing, and what I mean by the Fed is like the central bank, for any country that this would happen, the central bank would end up just injecting a lot of phony money into the financial into financial assets. So that basically, if you're familiar with quantitative easing, that's basically what would start up. They would just basically try to just buy up as much things as possible to just stop that deflationary death spiral, and try to put a floor on it. It would take a lot, but they could do it. The challenge with that would be that it would stabilize assets, but then it'd be a bunch of printed money into the system. So basically, what the Federal Reserve would end up doing is trying to take the place of what's normally being printed into the actual economy through the government, through government spending, right? That goes into, companies for research. It goes into universities for research. It goes into tax dollars. There's all sorts of things that government spending goes into. And what the Fed would do is they would attempt to stop that through the financial system. That would be very bullish and stabilizing for assets, but not for the underlying economy. So you'd get an even deepening divergence inside the economy, where assets wouldn't necessarily crash anymore once they stepped in, but the actual economy underneath would really degrade pretty dramatically. So it would create an economic catastrophe. So that's kind of how it all would transpire. Just to kind of give my theories on it. Remember, I follow more of like an Austrian business cycle, so that's kind of the lens in which I see things. So that's where we're at as far as the debt cycle goes. Am I concerned? I've gotten that question as well. No, I'm not concerned. We go through this every year. It's politicians trying to get what they want, and they're playing chicken with each other, and it's the new leverage stick. I wish that they my opinion doesn't matter as far as that's concerned, but that's as far as where we're going as far as financial markets. One thing that I will note, and this has actually been something that's been brought up a few times, is that do I take it into consideration? Do I play the what if situation? Do I hedge for it? Those types of things. Well, I always position size all of my trades accordingly, as you guys have seen in my systems. They're stable, right? You use a certain amount of allocation. You've got a certain amount of cash. I put some of my extra cash in like bond ladders and things like that. So, of course, you've got plenty as far as hedging goes, as far as positions. But that doesn't mean that you still can't take a hit, right? Absolutely. So, but you've got to take that risk, right? You've got to take that risk of events, because what I've noticed in the years of my trading is that there is going to always be a reason out there to not trade, right? It's someone talking. It's someone saying this. It's Federal Reserve interest rates. It's someone sending a missile over Japan. There's always something going on in the world. And if we focus on those news-oriented things, we end up missing what's actually happening in the markets. And so if we just follow the money, follow the capital flows, follow the macros, and just let the news be the news, a lot of the times, when I eventually do check in on the news, it was actually just creating a buying opportunity a lot of the times, right? Or a selling opportunity. It goes both ways, right? Right now we're not in an outright bear market recession anymore, so it's pretty much buying opportunities at this point. It's just how deep will the buying opportunity get, right? As far as this environment is concerned, what is this environment? I know that that's kind of what we stand for as far as environmental trading edge. But in general, this environment has very shallow pullbacks, right? They're not normally that deep. This one's actually been drawn out just a little while. We've gone very sideways. If I pull that graph up a little bit more, you can see that if I zoom in here to, and we'll go into the S&P really quick, right? If we go up to the S&P, you can see here that we've kind of come up and then we've trended very sideways for a little while. This is pretty indicative or pretty common for this environment. And I would anticipate us probably to launch higher and start pushing up a little bit higher into here. And it wouldn't even surprise me to get up into, way up here if we wanted to. So we'll kind of see, this would be our first little resistance spot up here, like 4,300. That probably won't happen until, mid-year or so. But something to note is that the models that I use for my macroeconomics, they are shifting bullish, and then in the third quarter of this year, they get excessively bullish. And I'm talking like really bullish. So we haven't had the signals actually going as positive as this since way back in COVID back here. So we had some bullish signals back here. That's basically like this, and then late 2020 was basically when we had it this aggressive. And then before that, we'd have to go even further back, and that wasn't until, it was 2017, right? 2017, that was when we got signals that were relatively this aggressive. And then prior to that, we got to go really, really far back, and it was 2009. So that's the environment we're in. That doesn't mean that everything goes straight up or anything like that. There's chops along the way, even in 2009. This is a deflationary recession. We did not have a deflationary recession. We had an inflationary recession. So just kind of pushing those, pushing that a little bit more. And, as far as the data is concerned, that's what we're in for, right? As far as the debt ceiling goes, we typically are going to get taken care of. And there you go. As far as other topics that we've had recently asked me, let me go see if I can read that question verbatim. Give me just a second here, guys. All right. This was an options question, and I wanted to cover this really quickly. Is I had said something on the last YouTube live, and the question was, "Hey, why did you necessarily say to go further out in DTE in higher volatility?" And I wanted to just kind of briefly discuss that for just a second here, because what happens in higher volatility is if you look at volatility as a whole, volatility mean reverts, right? So here, let's pull up a graph of volatility here, and this will be nice and let's just go grab the VIX. The VIX should be right here. Perfect. So the VIX, and let me just switch this to auto. All right, so the VIX is mean reverting. As you can see here, we kind of have these spikes and then we kind of gyrate around, right? But if we go back forever, right, the VIX, it's not like an uptrending asset or a downtrending asset, right? It rotates around a specific level, and it just kind of stays there. And inevitably you do get a larger spike, right? But inevitably it comes back down to, some sort of meaningful level. You do sometimes get some long-term suppressions, right? That was quantitative easing. And then of course we eventually, quantitative tightening. That was the volatility bubble back here in 2018. Those of you guys that trade options, you know exactly what I'm talking about on that one. So anyway, we've been gyrating around this upper level in these 24s. We've recently broke that back down into these lower levels. Once we broke down into these lower levels, now kind of the new norm is going to be that roughly 17 or so, until eventually we'll get another spike, right? We'll get some sort of event or something like that. I mean, who knows? It might be a debt ceiling thing. We'll see. But eventually it'll kind of push a little bit lower as the bull market goes on. So, give me one sec. So in general, as far as this is concerned, right, we have, here's the last couple days of this volatility spike. Why would we want to go further in DTE whenever we have a spike in volatility? Well, if you are thinking of the school of thought of volatility, you want to sell more volatility when volatility is higher, right? The higher the volatility, the more it's going to compress, right? You would think, right? Well, if you're a day out from volatility, or a day out from expiration on an option, you have very little vega weighting. And now this is getting a little bit more complex, but basically what ends up happening is when you're so close to expiration, the amount that volatility can impact an option really isn't a lot, because because the time side of things is more is stronger, right? So if you can kind of think about through time, right? So let's say an option starts out 90 days out. We're just going to talk about 90. Out there at 90, there's a lot of things that it can impact the price of that option, because there's so many events between that point and there, and there's so much potentiality between 90 days and zero. So the amount of fluctuation that it can have based on small variables in the market are relatively high. So that's that volatility, right? So you got to bake in a lot of volatility, or that IV, implied volatility, in that 90-day option, versus at 1 day, there's not a lot that can go on, right? So if you grab an option that is, let's say it's 100 points out or let's say it's like 500 points out in the SPX, right? That's going to be worth a lot more at 90 days versus 1 day, because in 1 day, you don't think it's probably going to do much, right? So anyways, taking that step a little bit further, right? The amount of time, right? You get one tick in a day, right? 1 day, right? 1 day out at 90 days is a very small fraction, right? So if we think about that, if you've got 90 days, right? If you've got 90 days and you have 1 day tick by, you're 1/90th, degraded, right? If you've got 2 days to expiration and you have 1 day tick by, that's half of the time value that's in that option, right? So as you get closer to DTE, time is the stronger pressure on the option, more so than the IV, right? So as an edge, when you have an IV spike, you want to push further out in time. It's not always the case, as you guys know, with my Adapt Advanced options or with any of my programs. You don't always want to push out in time, right? There are certain edges that you can push in at like 20 days or 14 days or even a week out or something like that. So you don't always want to push out depending on other variables in the environment, but we're just kind of going to hone in, or we're just talking about just this particular, this particular variable. In general, pushing out in DTE when you have higher volatility, means you can sell more of that IV and you can get a little bit of an edge. It's not always the case, so I'm going to put that caveat in there. But in general, that's a nice general rule of thumb. All right, guys, that's all I've got for you today. I thought it was a really good couple questions that we could knock out. Like I said, I'm not necessarily worried about the debt ceiling. I've got everything positioned well and position sized. And in fact, I've got a little bit of positive delta. Who knows if that's going to work out right, but I've just got to play for the probability and what the market's telling us. So that's where we're at. Until next time, guys, I'll see you next week.